This is Defense Domain. In-depth analysis on global security, military strategy, and emerging technologies. This analysis examines the economic dynamics of the Iran conflict and the structural drivers behind the April 8th ceasefire. Modern war no longer remains confined to the battlefield. It spreads through global markets, energy systems, and supply chains. This transforms conflict into a systemic economic shock. In this environment, economic constraints define the limits of war, not purely military capabilities. From a structural perspective, prolonged high-intensity conflict in critical energy corridors is unsustainable for all actors involved. Turning to the global framework, the Strait of Hormuz represents a critical vulnerability. Roughly 1/5 of global oil flows through this corridor. Any disruption immediately translates into global economic pressure. This shifts the nature of conflict. War becomes an economic event, rather than a localized military contest. Turning to Iran's position before the war, the country entered the conflict with significant economic fragility. Over more than a decade, sanctions constrained its energy exports. This resulted in an estimated loss of between $300 and $450 billion in potential oil revenue. At the same time, the national currency had already collapsed. By 2018, the rial had lost more than 90% of its value. Inflation remained extremely high. By late 2025, inflation exceeded 60 to 70%. Growth projections for 2026 were already negative, around -2%. This indicates limited economic capacity to sustain prolonged conflict. Turning to the initial phase of the war, the impact on energy markets was immediate and severe. Oil prices surged dramatically, from approximately $60 to $64 per barrel, to a peak near $121 per barrel. At the same time, physical supply flows collapsed. Normal regional flow of around 20 million barrels per day was severely disrupted. An estimated 10 million barrels per day, or roughly 13% of global supply, was removed from the market. This created a dual shock: rising prices and collapsing supply. This combination amplified global instability. Turning to global economic impact, the energy shock spread rapidly through the global economy. Rising fuel costs increased transportation and production expenses. This placed upward pressure on inflation across multiple economies. At the same time, growth expectations declined. Global GDP forecasts for 2026 were revised downward by approximately 0.3 percentage points. In the United States, growth projections fell from around 2.4% to approximately 1.4%. At the consumer level, purchasing power declined. In the United States, real purchasing power was projected to fall by around 0.6%. This reduced demand and reinforced economic slowdown. Turning to the ceasefire on April 8th. This moment represents a critical economic inflection point. While presented as a diplomatic move, it reflects systemic economic pressure. By early April, oil prices had peaked near $121 per barrel. Although they later stabilized in the mid-$90 range, volatility remained high. This volatility disrupted investment decisions and slowed economic activity. At the same time, escalation risks increased. There were explicit threats to target infrastructure, including bridges and power plants. Such actions would have caused long-term structural damage, particularly to energy and transport systems. This would have transformed a temporary shock into a prolonged global supply crisis. Under these conditions, the ceasefire emerges as a rational economic decision, a measure to prevent escalation beyond recoverable limits. Regional dynamics reinforced this outcome. Gulf economies faced a dual shock: rising import costs and constrained export capacity. Despite energy wealth, these states depend heavily on food imports. Up to 70% of consumption is imported. As supply chains were disrupted, food prices surged. Increases ranged from 40% to as high as 120%. At the same time, hydrocarbon exports were constrained. Up to 10 million barrels per day of potential exports were at risk. This directly threatened fiscal stability and long-term economic planning. Turning to the United States, the impact was indirect but significant. Fuel prices increased steadily. Gasoline prices rose by approximately 5 to 10 cents per day during peak volatility. This contributed to broader inflationary pressure. At the same time, recession risk increased. Under scenarios where oil prices could rise toward $150 to $170 per barrel, economic modeling indicated a high probability of global recession. In this context, the ceasefire acts as a stabilizing mechanism. It reduces immediate escalation risk and helps contain further economic deterioration. From a broader perspective, this conflict illustrates a structural transformation in warfare. Economic systems now determine sustainability, not just military strength. Conflicts are constrained by their impact on markets, on trade flows, and on financial stability. This changes the logic of escalation. States must consider economic consequences in real time. Turning to the core conclusion, modern warfare is increasingly self-limiting. Because of economic interdependence, the costs of escalation extend beyond the battlefield. They affect all actors and the global system as a whole. The April 8th ceasefire reflects this reality. It is not only a political decision, it is an economic recalibration, a response to systemic pressure, a mechanism to stabilize markets, and to prevent a broader global downturn. Ultimately, peace is not only a strategic objective, it is a structural requirement. Without it, inflation, disrupted trade, and declining output converge toward systemic economic breakdown. In a deeply interconnected global economy, the cost of war is universal and increasingly unsustainable. This was a defense domain analysis. For more detailed assessments, visit defensedomain.com. Stay informed, stay strategic.